Welcome back to The Explainer. Look, today we've got to break down something that just sent a massive shockwave through the markets. Wall Street's expectations totally upended. All right, so let's get right into it. The fact that Trump planned on replacing Jerome Powell at the Fed, well, that wasn't a huge surprise. But the name he dropped? Whoa, nobody saw that coming. And the market's reaction? A historic sell-off in stocks, gold, and silver. So what's with all the fear? Why is this one name causing so much chaos? Well, the reaction was lightning fast, and that's because this is what Wall Street calls its nightmare scenario. You know that safety net everyone's gotten used to? The idea that the Fed will always swoop in with easy money to save the day? For the first time in, over a decade, that's being questioned. And that's a level of uncertainty investors just haven't had to deal with for a very long time. Okay, so who is this guy at the center of the storm? Let's meet Kevin Warsh and figure out why Wall Street is so spooked. You know, if you look at his history, the guy is nothing if not consistent. Think back to the 2008 crisis. While pretty much everyone else was screaming for massive bailouts, he was the voice in the room saying, hey, this stimulus is way too much. Then in 2011, he actually resigned. Why? Because he was dead set against another $600 billion being pumped into the economy. And he's still at it, criticizing the Fed just a couple years ago for losing all credibility by overstimulating things post-COVID. So, what does this all boil down to? His whole philosophy is basically this: fight inflation, protect the dollar, period. Even if it means jacking up interest rates and slowing down the economy. And you have to realize, that is the complete opposite of the easy money party the markets have been enjoying for years now. And if that wasn't clear enough, get a load of this quote. We are basically enriching stockholders at the expense of everyday Americans. I mean, wow, that is a chilling thing for any investor to hear. He's not even hiding it. The message is loud and clear. He's perfectly willing to let the market tank if he thinks it'll help the real economy on Main Street. Okay, now we get to the big paradox here, the central conflict in this whole mess. For the last year, all we've heard from Trump is him blasting the Fed for not cutting rates. He wants them lower, faster. So why on earth would he pick a guy whose entire reputation is built on wanting higher rates? It makes no sense on the surface. And here's that paradox laid bare. On one side, you've got his entire career, his DNA, as a hawk. Higher rates, strong dollar, you name it. But then, look at his more recent comments. All of a sudden, he's talking about lowering rates, affordable mortgages, being a partner to the White House. It's like he's singing a completely different tune, one that sounds an awful lot like Trump's favorite song. So this right here, this is the multi-trillion-dollar question that has the market totally frozen. What's the real story? Is this a genuine change of heart? Is he just a sock puppet telling the president exactly what he wants to hear to land the job? Or, and this is the scary one, is this a Trojan horse? Does he get the job and then immediately go back to his old hawkish ways? Nobody has a clue. And if there's one thing the market hates more than bad news, it's uncertainty. All right, to really get why this is such a big deal, we need to pull back and look at the bigger picture. This goes way beyond just interest rates. We're talking about a fundamental fight over the future of the US dollar. And this chart just lays it out perfectly. It's a tug of war. On one side, you've got Trump, who wants a weaker dollar. Why? Because it makes American stuff cheaper to sell overseas, which juices corporate profits and pumps up the stock market. But on the other side, you've got Warsh, whose entire life's work is about a strong dollar to keep inflation in check. These two goals, they're like oil and water. They just don't mix. So here's the bottom line. That old playbook investors have been using for more than a decade, the one that says, don't worry, the Fed will always bail us out, that playbook might just be getting tossed out the window. The safety net could be gone, for real. Okay, deep breath. We've laid out the chaos, the uncertainty. It's easy to get swept up in the fear, right? So let's do this. Let's push the drama aside for a second and just look at the cold, hard, historical data. First things first, let's talk about volatility, because drops like this can feel terrifying, but are they normal? Well, since 1980, the S&P 500 has dropped an average of about 14% at some point every single year. And get this, that includes years when the market finished way up. So the takeaway is, these bumps in the road, they're not the exception. They're a totally normal part of the journey. And if we zoom out even further, the picture gets even clearer. In 34 of the last 45 years, that's most of them, the S&P 500 ended the year in the green. So despite all the scary headlines, all the panics, all the drops we just talked about, The most common results by a long shot is the market finishing higher.
Okay, but you might be thinking, what if it's really bad this time? Well, let's look at that. Historically, when the market has a pretty nasty correction, say 10 to 20%, the average time to get back to even is about 8 months. And even in the worst case scenario, I'm talking a full-blown crash plus a recession, the market has typically found its footing again in just 1 to 2 years. It's often quicker than our fears would have us believe.
But of all the numbers we've looked at, this next one might be the most important. It's the most powerful one of all. You want to know your chance of making money in the stock market if you just stay invested for at least 15 years? It's 99.8%. Let that sink in. It is about as close to a sure thing as you can find anywhere in finance. And this is the huge mental shift that separates successful investors from everyone else. They don't see a market drop as a crisis. They see it as a sale, a Black Friday sale for stocks. It's a chance to buy into great companies you believe in for the long haul, but at a huge discount. These are the prices you were probably dreaming of just a few months ago. So, look, in the end, nobody has a crystal ball. We don't know for sure what Kevin Warsh is going to do. We don't know how the market will react next week or next month. But what history tells us, loud and clear, time and time again, is that for people who just stay the course, it is time in the market, not timing the market, that builds real, lasting wealth. So the real question isn't about the Fed. The question is, are you patient enough to win?